and we're pleased to have Joe Laraco, business attorney who advises companies and entrepreneurs on corporate transactions, contracts, strategic business structuring across many industries. He has led clients through entity formation, M&A financing, and negotiation of complex commercial agreements, completing over $100 million in transactions. He has also served as U.S. Counsel and Directory of Strategy for Piccolitti Limited, where he helped secure a £50,000 Enterprise Ireland grant and holds a JD from Southwestern University School of Law and a bachelor's from Pace. And so without further ado, Joe, take it away. And I would ask that people all mute themselves unless they want to ask a question. Joe has said that you can ask interactively, but meanwhile, hit the mute button, please. Thank you.
So I've kind of broken down the presentation into 3 or 4 areas. I first talk about, like, for instance, when a client contacts me and there's some patent or trademark issues that come up, the discussions I might have with them. And then from there, it kind of goes to how they're set up. If it's a solo or partnership arrangement, we talk about business formations. So I'll talk about business formations in terms of corporations, limited liability companies, partnerships, and things like that. Then I talk about the different types of agreements that the parties might enter into if it's a limited liability company, and what some key clauses are and issues and considerations they should have to avoid issues down the line. And then I talk about licensing agreements and distribution agreements. So those are the topics, just to give you a heads up of what I'm going to cover. Initially, when a client comes to me, they talk about an invention and what they're doing, and I discuss with them to make sure they talk with a seasoned intellectual property attorney or patent, trademark attorney. And I discuss those issues with them, and then they'll contact somebody like Mike Blake and go over that with them. There's different types of agreements they can enter into, such as a joint ownership agreement, where they clearly define their rights, responsibilities, ownership interests. And it's important for them to identify those things early on, and determine what they want to do, whether it's a joint development agreement, and what their roles are. Maybe each person brings a different set of skills to the partnership. So they'll talk about that. There might also be an assignment agreement that's discussed, which is often used when co-inventors choose to transfer their rights to a single entity, such as a company or a third party, to simplify management and commercialization in the next phase. A number of times I've had clients who have contacted me, and they either have a Delaware C Corp set up already, and they're having problems with it, and they need to unwind it, or they contact me and say they're ready to go. They want me to form a Delaware C Corp with them. And I talk to them about that, and usually they've either read it online or gone to one of these online services, and they think they need a Delaware C Corp. And I always talk to them about keeping it simple. Delaware C Corps are usually for businesses or ideas that are going to be going on a large scale. They're going to be raising money with over 100 shareholders. And there's a very specific reason why they're forming a Delaware C Corp. So most of the time, 99% of the time, that client is not going to be using a Delaware C Corp. And sometimes, as I've said, they have to unwind it. And it's easy for me to do. We simply dissolve that entity, restructure it, and have it set up in Connecticut as a limited liability company. It's one of the things Connecticut does really well with their Secretary of State's office. To form an LLC, pretty quick and easy. It's a $170 filing fee, which includes an expedited fee of $50. If you don't pay the expedited fee, you could be waiting several weeks to get confirmation that the limited liability company was formed. Going forward after that, the annual fee report is only $80 a year. Places like California, they call it a franchise tax fee, even though it's really not a franchise, it's more of a corporate tax fee. They charge $800 a year, whether you're making money or a startup, it doesn't matter the size of your business, they charge $800 a year. New York, sometimes I have clients who have a choice of whether or not they do New York or Connecticut based on where they're living and commuting and things like that. And I try to talk them out of New York because of the tax situation in New York. And also they have this crazy law in New York for forming corporations or limited liability companies, which is a public notice filing fee that basically requires them to file a public notice in a print publication for, I think it's like 3 consecutive weeks for so many weeks. And depending on which county you're located in, whether it's Westchester County, New York County, it could add another $1,000 or $2,000 to your setup costs for a simple corporation or LLC. Another thing I talk to clients about when they're setting up their company and their invention is what are going to be their nexus states. And I've had clients come to me in the last 2 years regarding this issue where they got caught off guard. And it's something that the Connecticut Secretary of State has really not enforced until the last 2 years or so. So, and it started off like this. 2 years ago, I had a potential client contact me from New York. And he said he had an LLC in New York. He rented out a property in New York. And about 10 or 11 years ago, he bought a small property in Connecticut and he rented out the Connecticut property. So somebody told him he should get a certificate of good standing from New York and file a certificate to do business in Connecticut because he had a Connecticut nexus there. He had a piece of property there. So he went ahead and did this, he said, and he filled out the form online and he got authorized to do business as a New York LLC in Connecticut because of his Connecticut property. So no sooner does he do that, where a month or so later, he gets a demand letter from the Secretary of State's office in Connecticut saying he owes like $52,000 in penalties. And I said, well, wait a minute, you got this from the Secretary of State's office or from the taxing authority, the Commissioner of Revenue Services? And he said, no, it was from the Secretary of State's office. He said, I paid all my taxes. I did everything I did. They said I owed $300 a month for every month I was late filing from the time I was doing business in Connecticut. So what he did was he filled out a form online and he's being truthful. Said, when did you first start doing business in Connecticut? He put a date that was about 11 years ago. And that's when this department, who is now enforcing these fees, sent him a demand letter for the $52,000. He did not end up retaining me. I don't know if he negotiated with the Secretary of State's office on his own or he hired another attorney. I don't really know what happened. But I called a number of colleagues of mine who do business formations in Connecticut. And at the time, they had not heard of it or had any clients who were getting penalized with this law that was on the books. But within the next 2 years, I had 3 or 4 more clients contact me where I was able to negotiate down the fees and say, it's just a misunderstanding. Nobody knew about this law. They were small businesses. They weren't making a lot of money. And the option was they were either going to dissolve the company or, move to another state or do something else. So Secretary of State was understanding and reduced the fees quite a bit. So I was happy about that. But it points out.
Can I ask a question?
Yes.
Is that all right? Wouldn't it be an easy option to avoid all the fees simply by dissolving the company and then reformatting a new company? And what would be the downside?
Yeah, that's what I told them. And I said, that's your option. I said, if you don't have a very robust website and a big client base and you have nothing to lose, you could just change your name a little bit and dissolve it and form another company. They didn't really want to do that, though. Even though they were small businesses, they kind of didn't like that idea.
But why do they need to change the name if they dissolve it? Why can't
What's
they
that?
dissolve it? Why do
Oh,
they
yeah.
need to change the name? Why can't they just dissolve it? And once it's dissolved, then reincorporate?
My guess is that might have been red flagged. I don't know, but that could have been red flagged with the technology now. If they're clamping down on this now to get their $300 a month fee, they probably have a way of checking red flags and see if anybody did that. So the reason why I point this out, though, that was a New York situation coming into Connecticut. Well, my guess is that's the law in most books. I had another client that was doing a high-end fragrance, and they were actually out in the Middle East, and they had done business in Europe for many years. They entered the US. They hired me to be the liaison with their CPA firm and setting up their main office in New York. And they ended up doing business. They had, I think it was 11 or 12 different Nexus states. So if you're in Connecticut and you have a manufacturer in Rhode Island and you have a warehouse for your product in Maine, and maybe you have a fulfillment center in Massachusetts, each one of those states is considered a Nexus state. So what you need to do is you need to get a certificate of good standing from Connecticut. And I'm not sure if it's $50 or $100, whatever that fee is. Get a certificate of good standing from Connecticut and file a certificate of authority to do business in those other states, whether it's, Maine, Massachusetts, and Rhode Island, as in the example. If you don't do that and you realize, oh, shoot, I should have done this 2 or 3 years ago, you could be looking at a few $1,000s in penalties in those other states. So Nexus states are very important to figure out and keep track of as your business is growing and you're developing sales and things like that. The other nexus, so that's the business nexus. The other nexus is considered a tax or economic nexus. And that means whatever states you're selling into, you may need to get a tax ID number from those states and pay tax to those states for sales. An example, again, would be a warehouse, manufacturing department, and things like that. Most states now, and don't hold me to this because I don't give tax advice, but I point out the issues, but a lot of states, when it comes to internet sales, have now said they've tried to come up with a standard rule so that all the states would follow it, but some states, of course, have their own rules. But for the most part, and again, don't hold me to this, the internet sales rule is something like if you have more than $100,000 of sales in our state in any 1 year, that's a tax nexus. You need to get a tax ID number and pay taxes. If you have more than a sale of 200 units, or to 200 different people in our state, that's a tax nexus. You need to get a tax ID number, keep track of your sales, and pay taxes to our state. So keep that in mind, business nexus and tax nexus, both important and have 2 different functions. So with the LLC, I understand a lot of the inventors are solo inventors, and that's really easy. You still have an operating agreement. The only one you could get into an argument with then is yourself. So really easy to be a solely operated limited liability company. If you have 2 partners, and you're both putting in the same amount of time, you put in the same amount of money and effort, it's a 50-50 transaction. The operating agreement pretty much says everything has to be unanimous consent, because if it's 50-50, if you don't both agree, it's not going to go anywhere. So 50-50 partnership is not bad, and I counsel clients on various issues there. One of the issues happens sometimes where one of the partners has a different concept of where they want the business and the invention to go. And they might be all gung-ho, and they might want to spend more money, and they might have more money than the other partner. And that creates a little bit of a conflict on how they work that out. And one of the ways of working it out is either the partners agree this partner is going to put in a lot more money, so I don't mind giving him a higher percentage. And the other option is to make it a loan to the company. So that partner loans the money to the company with the idea that when it does start making money, he'll get paid back what he's put into the company. So those are two ways of dealing with it. The LLC, of course, protects your personal assets as long as you're not doing an intentional or personal act. It'll protect your personal assets, and that's the reason why you want to have a corporation or an LLC. The other thing I counsel clients on is even though they have the LLC, at some point they really have to strongly consider when this product becomes commercialized and is out in the market, even if it's a prototype, insurance. So what if it's a product that people could, in some conceivable or unconceivable way, get hurt? Talk to an insurance agent, and I tell them to talk to 2 or 3 insurance agents and get quotes and see what they can get covered. And this includes not only from the product itself, but also from their website. Because if they're having people buy things from their website and it gets hacked, then we're talking about various damages that they have to take care of. So insurance is always worth it, because it's not just that the insurance company will pay a legitimate claim, but it also means that if somebody is severely injured, they're going to hire an attorney. So you've got an attorney appointed by the insurance company that specializes in product liability claims, and they will handle the claim for you. And either they'll fight it all the way and say, this is a bogus claim, the insurance company is not going to pay anything, we're going all the way. Or they may see it as a legitimate claim and say, you know what, we need to just negotiate and settle this, work something out with the other side. And that's what the insurance company is there for. So you've got legal counsel and personal liability protection. A limited liability company, there's 2 types of categories for the people that are in the limited liability company. One is members and one is managers. Members you can think of as the equity owners or shareholders. If it was a corporation, it would be called, they'd be called shareholders. A limited liability company, they're called members. The other type are managers. Managers are the people who run the day-to-day operations of the limited liability company. Managers, if it was a corporation, would be the officers and directors of the company. Oddly enough, I've seen it happen a few times where a limited liability company decides to use the term president or CEO. And it is allowed under the Connecticut General Statutes, Connecticut law. You can't actually have different designations. You don't have to go with just members and managers. So you could actually appoint a board of directors. You could appoint a president, vice president, and things like that. But most commonly, since these are small businesses with usually no more than 5 members and managers, almost always they're sticking with the terms members and managers. If you have a manager who is not a member, an equity owner of the company, it's a good idea for them to have a separate management agreement. One example that comes to mind is where you have a restaurant and you go in to get seated. There's usually the maitre d' or manager of the restaurant. And a lot of times that person is not one of the owners of the company. They're the manager who's making sure everything is going smoothly for the restaurant that evening with seating and arrangements and reservations. We talked about with 2 partners having unanimous voting rights, which basically means both partners who are 50-50 have to vote and agree on which way the business is going, whether or not money is going to be put into the business, whether or not a licensing and distribution agreement might be entered into with another company, or whether or not the company is going to develop it and sell it on their own. Whether or not an employee or consultant is going to be hired. When there are more than two partners, we get into questions of voting rights, and the client may tell me, okay, so we've got 4 members, and it's going to be 40, 40, 10 and 10, or 10 and 15. Let's say 40, 40, 10, let's say 40, 40, 80, and 15 and 5. And sometimes they don't realize that that 15% member becomes very important, because 40% and 15 is 55. So now you have one of the main members, and then one of the smaller members who can actually control the company if you just leave it up to majority vote. So I talked to them about the idea of defining voting rights in terms of a supermajority and defining what that might be. So if you had a 40-40, 15 and 5 breakdown of ownership, you might define supermajority as 80%. So that would be the 2 main founders, co-founders, saying, yeah, we don't mind them having some equity, but we have to control everything. So we're going to define supermajority as 80%, and these 5 items require a supermajority for the company to do it. And that includes licensing and distribution agreement, hiring an employee, putting more money into the company, changing the direction of the company. So we need to spell out and make sure we understand, when there's other people involved in the company, what the voting rights are and how that's going to affect the direction of the company. Had situations where either a solo inventor or joint inventors come to me, and I ask them about their background and what businesses they've been involved in or currently involved in. And a fair number of occasions, I've had to ask them, okay, so when you worked at this other company for 5 years, did you sign anything? And they think about it and they say, oh yeah, I signed some sort of confidentiality agreement back then. I say, okay, I need to look at that, because a lot of times, especially 5 years later, or 3 years later even, they're not thinking, oh yeah, I signed this agreement. What was in that agreement? It might have had confidentiality language. It might have had intellectual property language that said, if they conceived any idea that was a product or idea or service that was in competition with what the company does, that idea, concept, or invention belongs to the company. So that's a very important part of the process when I talk to these clients, to make sure they don't get in trouble down the line, or they get a waiver, or just that they understand what's going on, so there isn't a problem down the line. Another example with co-inventors is where they've been in business a long time. They have their own businesses. They're successful. They know each other, and they come up with this idea or concept. And it's somehow partially or indirectly or directly related to what one or both of them does. And the operating agreement, well, first of all, in an operating agreement, the members owe fiduciary duties of loyalty and trust to one another. So once they form that LLC, that operating agreement has to be pretty detailed if they have these past lives that might interfere with what they're doing in this new company. They can't direct deals away from the LLC to their other business. They can't self-deal. Anything that is closely related to that new line of business, that new invention, really belongs to the LLC. So what we have to do is we have to do a very careful carve out and say, okay, if any of these clients, and sometimes it could be as simple as saying, okay, I have 10 large clients I deal with all the time. It's all repeat business. I get to keep those clients no matter what kind of business comes in. Or we might define it by saying anything that has to do specifically with, the co-inventor's business can be given to the co-inventors, but there has to be disclosure. Sometimes there's a notice provision that says, hey, if that does happen and it's a gray area, I'll let you know. We'll offer it to the LLC first and see if it's a fit. If not, then I get to keep that client. So sometimes there's gray areas that can make it sticky. It becomes tricky when the two co-inventors want to go their separate ways. And the question of a buyout, what's the value of the patent or the invention? Is there going to be a buyout? Sometimes one partner says, you're not going to buy me out, I'm going to buy you out. And sometimes it can become pretty contentious. So it's really important to try to figure out all the issues there are in the operating agreement so that somewhere down the line, when the problem occurs, they go to the operating agreement and say, well, previously this is what we agreed upon, so let's follow the operating agreement. That's not to say that if these partners or co-inventors have a problem down the line, they can agree on anything they want to. Maybe the agreement said this is how the buyout's going to take place. We have to get a third-party appraiser. He's going to come in. He's going to do it. If the parties agree, I'm just going to buy you out for $50,000. Are you okay with that? If they agree, they could agree on anything they want to, even if it's not in the operating agreement. As long as there's an agreement and they sign off on it, it's perfectly fine. They don't have to be bound by the terms of the operating agreement if they agree.
Joe, I was wondering if I could ask a question.
Yeah.
A lot of times I get international students who are going to be involved with a startup business, and they'll do business plan competition, and then they're not from this country because international students, what good are the NDAs if they're signing these things and then they return to their country, and what are you going to do? Run them down and domesticate the judgment if you get a judgment, and try and enforce a judgment against students who kind of have no money? I mean, does it make any sense to have NDAs under those circumstances?
It does. We have a saying that is that NDAs are only worth the paper they're written on. It's more about the relationship of the parties. Trying to sue somebody on an NDA, even if you win in Connecticut, let's say you get a judgment against somebody in Connecticut, they're in California, even trying to enforce it across state borders is difficult, let alone across, countries. It's next to impossible. I guess the more difficult situation would be with software. You have a software developer, you pay them to develop something. This person moves out of state or out of the country, they realizes, hey, I built this thing. I could sell it to 50 or 100 other people, So now he's built it. You paid for it. You think it's your exclusive software. And now all of a sudden you see all these competitors popping up all over the place with this software. It's a problem. I don't know how to answer your question other than to say the bigger you are, probably the better, because let's say you're the inventor and it goes really well and you're making, you're making $1 million a year on this. And this person who worked on it, decides to start selling it in
Alexa, name
California
books by
or
social
some other
needs.
country. Well, if you're big
There are
enough,
no books matching Shasta Nietzsche in your Audible library.
Alexa, what books did Solzhenitsyn write?
I
Hey,
don't know that one.
Philip Ben, can you go mute? Philip Ben,
Okay.
can you mute yourself?
think we're okay now. Maybe. Oh, no, it's not. Oh, there it is. There, it's muted. Okay. So I'd say that's a problem, Doug, but the bigger you are, the more you're able to do that and maybe make an example of somebody the first time it happens. That's one way of looking at it, I guess.
Well, Joe, isn't it like any other cause of action? If they're out of state, you're going to have to get a judgment and then enforce that judgment in a different state. I mean, even for a federal lawsuit, you still have to, just because you won, you still have to enforce it. So if you had a patent infringement lawsuit that you won, you have to enforce it. And if the guy's in a different state from the court, you still have to enforce it, don't you? It just depends on how much effort you're willing to put into enforcing your judgment.
Right. And in different situations, I've talked to clients and I've said, well, first of all, I'm not doing litigation anymore. Second of all, where are they located? And they'll say, okay, this guy's in Cherry Hill, New Jersey now. So I said, okay, go online, find the strongest litigation firm you can find, try to find a pit bull litigator in Cherry Hill, New Jersey, who lives right in town where the guy lives. So now he's going to get a notice letter. He's going to get a cease and desist letter. He's going to look at the letter and he's going to say, oh, shoot, this is a law firm in Cherry Hill, New Jersey. They're a mile down the road from where I live. They're serious. They're coming after me. Rather than some Connecticut lawyer sending a cease and desist letter, it's not going to mean anything. So that's a little bit more helpful. I've also seen another tactic used by larger companies. I've had some young guys who've left companies, and within 2 weeks of them leaving this company and they worked for, they get a letter from an attorney saying, you have to cease and desist from contacting any of our clients. We understand you've done this. We understand you've done this. And the client calls me and said, Joe, I didn't do that. This one client called me once. I told them I can't do business with them. I'm starting my own company. I'm starting my own business. But it seems like some companies, and it depends on the relationship and the personalities of the parties. Some of these companies, as soon as you leave, they're firing off a letter and they're putting you on notice. Hey, if you contact any of our clients, if you violate the confidentiality agreement, we're going to come after you. So they're just putting people on notice right away. I don't particularly think that's a good practice. It seems like they have more to hide, like maybe they were pushing their employee too much with improper sales tactics and things like that. But that's one thing I've seen happen more often now is corporate attorneys sending these nasty letters to somebody when they leave a company. Since we're on the subject of business disputes and confidentiality agreements, next on my list I have mediation, arbitration, or litigation. So in the operating agreement, we can put a clause in there that says if the parties have a disagreement, they can either submit to non-binding mediation, or they can go litigation, or rather arbitration, or last resort litigation. Some clients, not too many, but some clients have liked the mediation idea. They said, you know what, if we have a disagreement and we're really butting heads, we want to appoint a mediator and we want to try to resolve it in 30 days. If the mediator and ourselves can within 30 days, then we'll go to arbitration or we'll go to litigation. But mediation is basically meant to have an impartial third party hear both sides of the story. And based on the facts and some law, and looking at the operating agreement, make a determination or recommendation, I should say, make a recommendation to the two parties. The parties could either accept it or reject it, or if it's close enough, they could even make a counter proposal. So mediation sometimes is a good idea because you have an independent third party who's not taking any sides. He's just looking at the facts, looking at the agreement, looking at the law, and saying, this is what I think you should do. This is how you should settle it. Arbitration, you could have either a 1 or 3 person panel, set an arbitration date, and it's just like litigation, but it's more formal. It's usually heard at an attorney's office, and they make a decision. And litigation is the final route. Attorneys like to say nobody wins in litigation, except the trial lawyers, right, Mike? Better to settle, better to settle. Okay, last week we're going to talk about licensing agreements. So I've actually done quite a few agreements where even if it's not a licensing agreement, depending on the consulting agreement or what service is being provided by my client and the counterparty, sometimes there's a reason for me to put in a licensing clause that basically, sets the tone and sets everybody straight, saying that you may have the right to use this that's owned by my client, but it's only a right to use the invention or the software, for instance. They don't have the right to reverse engineer it, to modify it, to sublicense it out to somebody else, or take any kind of ownership rights in that invention or software. A licensing agreement is more full-blown. That is the total purpose of the agreement is they're entering into a specific agreement where the counterparty wants the licensing rights and is going to try to license, they might have a reason for using the license to that invention or software for their own business. So they might be using it internally and they want to license it and use it because it's helping them with their own business. So again, it has to be specifically spelled out what rights the licensee has from the licensor. And it's not ownership rights, it's only the right to use that license for a specific purpose. And we try to make it as specific as possible and set clear guidelines on what the use of the license is going to be for, and more importantly, what it's not going to be for. Because you don't want the owner that's giving out the license to be butting heads with this other party, with clients or something they may be doing to develop it or promote it in the future. So you want to have very specific parameters on that license. They're used, in many different types of industries: software, technology, entertainment, manufacturing, e-commerce, healthcare. And the licensing agreement provides a legal framework that allows the business to leverage their intellectual property to others so that they could use that license. The scope of the license may have to do, like I said, it might be used internally by one corporation, or it might be licensed so they could use it in a specific geographic area and for a specific duration. The distribution agreement, usually they're almost synonymous, licensing and distribution agreements, and that has to do with where a company has a footprint, or it has a large client base maybe, or network, where they can distribute that product. And that's where the inventor and the distributor have to work out some sort of royalty or commission plan. And again, that's going to spell out a number of factors such as geographic territory, Pricing might be included. What changes or packaging can be used. And there might be an exclusive territory carved out for that distributor. Sometimes it's regional, sometimes it's national. Could be international, could be by country. The benefits of a distribution agreement so that the inventors can leverage what they have. And Doug, we talked early on, you were talking about some inventors are very good at what they do, but then getting to the next phase in distributing and monetizing is another question. And that's where the distributor comes in. Some of these distributors can really blow a product out into the marketplace and really get a lot of exposure. I think one of the benefits on Shark Tank, actually, they don't talk about it too much. They talk about more of the other things they bring to the table. But one of the things I don't think they talk about enough on Shark Tank is the distribution lines that they bring in. So yeah, they're putting in money. Sharks are putting in money. They're putting in expertise and knowledge, but they're also getting it to market. Mark Cuban, I know, has said a number of times on Shark Tank, sales cures all problems. You can have the best product, but if you don't have sales, you don't have anything. So, you got to be able to get it into the market and sell that product.
Joe, I was wondering, do you do work with royalty agreements?
Yes, I've done some royalty agreements. It's whether you want to call it a royalty, a commission, depends on what you want to call it. But yeah, I've done royalty agreements. One of the interesting things about the agreements is, and we've gotten into some real battles regarding the definition of net sales, net income or net sales. And the entertainment industry is notorious for creative accounting. And so you have people who put money into an entertainment project, whether it's a film or something else. They put in the money, and then when it comes time for them to get their royalty or their commission, all of a sudden, all these costs come out of nowhere. And they use the term creative accounting. So it's basically to come up with as much cost and overhead, and everything is possible, so that a lot of the investors are just, they're lucky if they get their money back sometimes. So yeah, royalty agreements can be tricky. I always try to get it based on gross sales, not net, just because it creates a real quagmire of, well, what are the costs? Let's see your books, let's see your accounting. So it becomes a real problem. That's about it for my presentation. Anybody has any questions or comments?
Joe, talking about entertainment, one thing I remember reading about was Forrest Gump, the movie. It was a huge hit when it came out, but according to their accounting, it was in the red. It was it didn't make money, and so the author got like points, but after points after net, basically. So the way they accounted it was, oh, they're still in the red. They still owe all this money, but it's a giant hit, and everyone knew it was just kind of a scammy thing that the studio was doing to the author who wrote the novel, and he was supposed to get some points based on net profit.
Somebody in the entertainment industry told me a while back that the distributors make a lot of money. So in other words, or the promoters, so they come in last. So think of it as, millions of dollars putting in, the actors are hired, the directors, everything's done. Now they're ready to get this out to the theaters. And that's when the distributors and promoters come in. And the distributor will put up, say, whatever it is, I'm going to put up $3 million. We're going to run an initial screening on, 40 theaters in these towns. And then they start to develop it and promote it from there. But he said to me, they're the last money in first money out. So that's a great, that's a great position to be in. You know, if you're making a markup, getting paid for all your expenses and costs, you're the last money in, you're the first money out.
Well, I hope everyone will join me in thanking the speaker. Thanks, Joe. That was a great presentation. Thank you.
Oh, thank you. Thank you for having me, Doug.
Good job,
And
Joe.
Mike.
Next month, on the 22nd in April, we'll have Timothy Snowden, a patent attorney who is recommended to us by our illustrious speaker chair, Mike Blake. Thank you, Mike. I'm hoping that we'll be able to fill up our speaker schedule. I've got somebody coming in in May and June, and then I got a couple of blank slots. So if you know anybody who'd be interested in giving a presentation to the Inventors Association of Connecticut, don't be shy. I'm very happy to reach out to people and bring in new speakers. My Rolodex is getting very stale. And if I keep bringing in people you've already seen, it's just not going to be as interesting as the presentation that we had here today. So thanks so much, Joe. This was the first time you've been on, and it's been great. And I hope everybody else hope everybody has a great evening, and we'll see you next month.
Thank you.
I learned a lot. I really did. I really appreciate it. Nice presentation.
I
Oh,
did
thank
too.
you. Thank you.
I did too. All right.
Does
Thanks a
everyone
bunch.
know where Joe is? I mean, Joe, did you give your last name? And you're located in Stratford, right?
Yeah, it's Joe LaRocco, and I'm located in Stratford, Connecticut.
I'm across the river from you in Milford. I think I can see your house from here. All right. We'll see you later,
Okay.
everybody. Bye-bye.
Take care.
Thanks,
Take
Joe.
care. Bye. Thank you. Yeah, bye.